Hello students, welcome to the ongoing lecture series on international business. We have been discussing international finance and this is the last part, that is part 6. I am Professor Soma Sen Gupta, Kamla Nehru College, University of Delhi. In this lecture, we will discuss the following topics: venture capital, foreign investments in Indian perspective. Now, beginning with the first topic, that is venture capital. Now, you know that many small companies then require the fund, but heavy risk is involved. So, everybody is not willing to invest in such type of companies, especially at the very early stage, or say startup companies. So, there are a specific group of people who provide the capital to this type of companies, and they are the venture capitalists. So, venture capital is a form of private equity financing provided by firms or funds to startup, early stage and emerging companies that have been deemed to have high growth potential or that have demonstrated high growth. But of course, risk factor is involved, and that is why funding is a difficult task for them. So, the venture capitalists, they invest in such type of companies. High growth potential is in terms of number of employees, annual revenue, scale of operations, etc. Venture capital firms or funds invest in these early stage companies in exchange for equity or an ownership stake. So, that is the beauty of this type of funding. So, the venture capitalists actually become the equity shareholder or owner of that company, but later on they can sell it off after the company is established at a very high profit. So, that kind of arrangement is there in case of venture capital. Venture capitalists take on the risk of financing startups in the hope that some of the companies they support will become successful. So, that is the main goal of venture capitalists, that the firm which is quite risky, they are buying the equity or investing in that company. Once it becomes successful, they will gain out of it by selling off their equity shareholding. Because startups face high uncertainty, venture capital investments have high rates of failure. So, that caveat is also there, that the venture capitalist is taking huge amount of risk and there is a chance of failure also. Startups are usually based on an innovative technology and often come from high technology industries such as information technology or biotechnology. These investments are high risk but offer the potential for substantial return if the company succeeds. So, beyond money, venture capitalists often provide strategic guidance, mentorship and access to industry networks. So, these venture capitalists, because of their experience in this field, they not only provide the funds, but also technical guidance and mentorship to the startups. Now, let us discuss the working of venture capital. First of all, funding source is the first step. Venture capitals company or capitalists, they raise money from large institutions like limited partners or pension funds or endowment funds and firms. So, mopping up the funds is the first stage of venture capital. Then investment targets. Now, the venture capitalists look for interesting investments where there is high growth potential. So, startups with high growth potential, often in technology based or innovative sectors, they are targeted by the venture capitalists. From seed funding like early ideas to later rounds like series A, B, etc., as the company grow. So, these are the stages of investment. Then return on investment. Now, VCs or venture capitalists have the aim for significant returns out of investment, and that is like 25 to 35% plus annually they want from the whatever capital they are investing in the startup. They wish to get this much annually as a return on investment. So, when the company is sold or acquired or it goes public IPO, so the venture capitalists, they earn that much of return out of the startup or the company which they have funded. So, this is the earning part, but they also go beyond money. As I said, they have the expertise, so they offer expertise, network and strategic guidance, and not just only the fund or the cash when they are promoting a particular company. Now, coming to the types of venture capital, so different type of venture capital is there. So, they can be classified into three types. One is pre-seed venture capital, then there is seed funding, and then early stage funding. So, beginning with the pre-seed or seed rounds, these are the initial stages of funding for a startup company, typically occurring early in its development. So, this is the earliest stage of business development when the startup founders try to turn an idea into a concrete business plan. They present this business plan, the startup founders, they present the business plan in front of the venture capitalists, and they may enroll in a business accelerator to secure early funding and mentorship. Then comes seed funding venture capital. This is the point where a new business seeks to launch its first product. So, they have gone beyond the pre-seed stage. Since there are no revenue streams yet, the company will still need venture capitalists to fund for all of its operations. So, that fund will be considered as seed funding. During seed round, entrepreneurs seek investment from angel investors, venture capital firms or other sources to finance the initial operations and development of their business idea. Seed funding is often used to validate the concept, build a prototype or conduct market research. So, it is at the early stage of product formation. The initial capital injection is crucial for startups to kickstart their journey and attract further investment in subsequent funding rounds. So, on the basis of the venture capitalist fund or the angel investors, they can develop a prototype of the product before launching it full scale. Then comes the early stage funding venture capital. So, they have already developed the product, now they have to launch it. So, it will need additional capital to ramp up production and sales before it becomes self-funding. So, here also they need venture capitalists and angel investors because they need a huge amount of money to launch the product which they have developed. The business will then need one or more funding rounds, typically denoted incrementally as Series A, Series B, and at each of the stage they will be requiring funding from the venture capitalists. Typical venture capital investment occur after an initial seed funding round. The first round of institutional venture capital to fund growth is called the Series A round, and thereafter there will be Series B and so on. Also, venture capitalists provide the financing in the interest of generating a return through an eventual exit event. So, this is very important that venture capitalists will not stick to a firm for a very long period of time. Once the firm becomes successful and venture capitalists know that now if they exit, they will get the maximum return. So, after establishing the startup or the firm, when it becomes successful, the venture capitalists eventually exit out of the the startup or the firm. So, that is the motive behind venture capitalists investing in that firm. Now, this is also known as exit event, and the exit event are companies selling shares to the public for the first time in an initial public offering, or disposal of shares happening via merger, sale to another entity, or via a sale to trading company such as a competitor. In exchange of the high risk that venture capitalists assume, they get significant control over the company decisions in addition to a significant portion of the company's ownership and consequently the value. Once they exit, they get a very good value of out of it. Companies who have reached a market valuation of over $1 billion, they are referred to as unicorns. You must be hearing unicorns quite often. So, these are unicorns which have a market valuation of over $1 billion. As of May 2024 data, there were a reported total of 1248 unicorn companies all around. Now, the pros and cons of venture capital. Now, we know that we can get funding for the startups and all. So, the pros are it provides early stage companies with capital to bootstrap operations. Companies do not need cash flow or assets to secure venture capital funding. So, securities are not required. Venture capital backed mentoring and networking services help new companies secure talent and growth. But there are certain cons also, because it demand a large share of company equity. The venture capitalists will need that kind of share in the company. Companies may find themselves losing creative control as investors demand immediate return. Venture capitalists may pressure companies to exit investments rather than pursue long-term growth. So, the venture capitalists only want a high return, and they are not emotionally attached with the startup. So, the founder of the startup may want the startup to be successful and go in long run, but the venture capitalist is eventually they want higher return by selling off their shares. Now comes the last topic of the international finance, and that is the foreign investments in Indian perspective. So, if we say the foreign investment has increased tremendously on account of different factors like high profit potential in a developing country like ours. So, we are getting funds, we are the foreign institutional investors and foreign direct investment is happening in our country because they are getting huge returns as well. Then economic policies and removal of restrictions, improvement in technology. So, these are the changes that are happening in the market. So, they purchase, there are different ways through which foreign investment is taking place from Indian perspective. If we say there is purchase of other securities by non-resident Indians, NRIs, then Indian depository receipts, purchase of other securities by foreign institutional investors or qualified foreign investors and long-term investors, which we will discuss in detail later on. Then investment by multilateral development banks, foreign investment in instruments issued by banks in India, infrastructure debt funds. These are different ways. So, first is purchase of securities by NRIs or non-resident Indians. So, it can be on the basis of non-repatriation basis and repatriation basis. So, we will discuss both of them, patriation basis and non-repatriation basis. So, NRIs can purchase shares or convertible debentures issued by an Indian company on a repatriation basis without any limit. So, they cannot take out the money and go back to their country. So, the amount of consideration shall be paid by way of remittances through normal banking channels. The remittance through normal banking channel are out of the funds held by the non-resident external account or non-resident external this account maintained with authority depository category, that is category 1 bank. So, NRIs can purchase government securities, treasury bills, unit of domestic mutual funds and unit of money market mutual funds. So, they can do that, different ways are there. NRIs are not allowed to make investment in small saving schemes and public provident fund account. Capital appreciation and sale proceed will not be repatriated abroad. So, NRIs are not allowed to take back that money. They can invest in non-convertible debentures issued by Indian company both on repatriation and non-repatriation basis. So, on patriation basis, if we say the NRIs are allowed to purchase government securities, treasury bills, unit of domestic mutual funds, bonds issued by public sector undertakings on repatriation basis without any limit. Then comes the Indian depository receipts. So, when we talk about IDRs, that is Indian depository receipts, Ideas are financial instruments that allow foreign companies to raise capital from Indian investors without directly listing their shares on Indian stock exchanges. So, ideas can issued by foreign companies to raise fund from India as per the SEBI, Securities and Exchange Board of India regulations 2000. They are similar to function to American Depository Receipts ADRs and Global Depository Receipts GDRs, but are specific to the Indian market, and that is why they are known as Indian Depository Receipts. The key features if we say of ideas are, first is rupee denominated. So, we said that it can trade in Indian rupees only, which helps mitigate direct currency risk for Indian investors. Then traded on Indian stock exchanges like the National Stock Exchange and the Bombay Stock Exchange. So, they are listed there and traded on recognized Indian stock exchanges. Then underlying shares are also there. Each idea represent a certain number of underlying equity shares of the foreign company which are held by an overseas custodian bank. Then another feature is regulatory oversight. There is the issuance and trading of ideas are regulated by the SEBI, that is Securities and Exchange Board of India, and also by RBI under the Foreign Exchange Management Act. Investor rights are protected. Holders of ideas are entitled to receive corporate benefits such as dividends, bonus issues and voting rights equivalent to those of direct shareholders distributed by the domestic depository. Diversification is another feature. Ideas provide resident Indian investors with an accessible way to diversify their portfolios by gaining exposure to international companies and global growth opportunities. Now, what instruments can be or intermediaries which are involved in ideas? One is the issuer company, that is the foreign company seeking to raise capital in India. So, this is the first intermediary, issuer company. Second is overseas custodian bank, that is a bank outside India that holds the actual underlying shares of the foreign company. Third is domestic depository, that is a SEBI registered entity in India that issues the ideas against the custodian's authorization and manages investor records. Also, there is another intermediary, that is the merchant banker, a SEBI registered entity responsible for the due diligence, filing of draft prospectus with SEBI and managing the issuance process. So, merchant banker is another intermediary. Now, another form of investment in Indian markets is purchase of securities by foreign institutional investors and long term investors. So, they can invest on repatriation basis in government securities, treasury bills, listed non-convertible debentures, bonds, commercial papers and units of domestic mutual funds, to be listed non-convertible debentures or bonds only. So, by these forms FIIs and long-term investors can invest in Indian companies. Security receipts are issued by the assets reconstruction company and perpetual debt instruments. The present limit for investment in corporate debt instrument, FIIs and other long-term investors registered with SEBI is $1 billion US. Also, there are other limits like the total holding by a single FII in each tranche of scheme of security receipt shall not exceed 10% of the issued value. The total holding of all FIIs taken together shall not exceed 49% of the paid up value of each tranche. So, some limits are put on investment by foreign institutional investors. Then another form of investment is by multilateral development banks, MDBs. So, MDBs are specifically permitted by Indian government to float rupee bond in India. They can purchase the government securities also. MBDs like the World Bank and Asian Development Bank are crucial investors in India. So, big banks are investing in the form of MDB in India. They fund major infrastructure development projects, roads, water, climate. So, this is a very important kind of investment because they invest in turnkey projects. They provide concessional loans, technical help, policy advice, aiming for poverty reduction, sustainable growth, often attracting private capital alongside public funds with focus shifting to green finance and systematic resilience. So, they have more social motives or objectives or social responsibilities that they fulfill through MDBs. Then they provide stable long term financing that commercial bank can't in the long run, and complementing India's own growth, especially in climate action and poverty alleviation. So, if we enumerate the areas of investments of MBDs, then one is infrastructure, as I said, roads, energy, water, sanitation and digital connectivity, climate change, adaptation, mitigation, renewable energy and nature based solutions, human capital, whether it is health, education, social development programs, private sector, that is mobilizing private finance for developing through co-investment and risk sharing. Then another form of investment is done by qualified foreign investors, which is known as QFI. Now, who are these QFI? It is a subcategory of the foreign portfolio investor and refers to any foreign individual, groups or associates or residents from a country that is a member of FATF, that is Financial Action Task Force. So, they were introduced in the 2010s, but later on independent qualified foreign investors are not allowed. Now, the QFI program was announced in the Union Budget of 2011 by the Government of India in cooperation with RBI and SEBI. So, from there they operated for quite some time independently. The goal of allowing QFI is to deepen and infuse more foreign funds into the Indian capital market, as well as to minimize market volatility, because individuals are regarded as longer term investors than institutional investors. The benefits of QFIs are increased capital flows in India. The QFI are diverse group of investors, so it reduces the volatility of Indian equity market caused by FIIs abrupt inflows and offloading. So, FIIs many a time they play with the Indian equity market, they enter, they infuse funds and there are inflows and then the offloading also happen, but this does not happen with QFIs. Then minimize transaction cost and complexity that had previously existed due to the huge number of intermediaries. So, you are removing the intermediaries, so transaction cost goes down. Improve the transparency also in the Indian financial market, unlock the untapped investment potential of many sectors. Then, but the category of qualified foreign investor in India no longer exists as a standalone investor class. It has merged into the broader foreign portfolio investor regime in 2014 to streamline foreign investment regulations. Also, there are infrastructure debt fund, that is another way of investing, that is infrastructure debt funds, IDF. So, the government of India has introduced IDFs in order to raise long term funds to infrastructure project for undertaking the government ambitious program of infrastructure development. So, infrastructure also requires huge amount of money and this comes through IDF. They were introduced by government to bridge the infrastructure funding gap and provide an alternate to traditional bank lending. The structure is like IDF NBFC, that is non-banking financial company, or through mutual funds, that is IDF MF. So, when we talk about IDF NBFC, it is regulated by RBI and extends loan to operational infrastructure projects, and they issue long term rupee and foreign currency denominated bonds as well. When we talk about mutual funds, this is regulated by SEBI. Now, let us summarize whatever we have studied in this lecture. So, venture capital is a form of private equity financing provided by firms or funds to startup, early stage and emerging companies that have been deemed to have high growth potential or that have demonstrated high growth. The type of venture capital or VC include pre-seed VC, seed funding and early stage funding. VC provides early stage companies with capital with no need of assets to secure VC funding. But VC funding or venture capital funding demand a large share of company equity and leads to losing the creative control. So, this is the con of VC. Foreign investment from Indian perspective, if we say, this includes purchase of securities by NRIs, Indian depository receipts, purchase of securities by foreign institutional investors, qualified foreign institutional investors and long term investors, investment by multilateral development banks and infrastructure debt funds. So, all these we have discussed in this lecture. For your reference, you can refer to the books by International Business by C.B. Gupta, International Business by Sumati Verma. Another is Chaturvedi and others. Also, there is Hill and Hult, International Business, competing in the global marketplace. Also, there is EPG Pathshala, e-Pathshala website. You can go and you can check out these topics. You will understand them better. I hope you have understood it well. Have a nice day. Thank you, students. Have a nice read also. Thank you.